In this video, we're going to deep dive into LandBridge Company LLC to see if it may be the new and the next Texas Pacific land now that TPL value is extremely high. About this company, it got IPO'd in June 2024 at $23, so you had a very strong performance since the IPO, 60% growth year over year, 88% EBITDA margin, 40 to 60% growth expected in 2025. So very solid growth expected for this stock. Do we actually have a high growth potential for the stock, or the future growth is already priced in? We'll discover this in this video. Since the IPO, it has really outperformed the S&P 500 with a performance of 100% compared to 13%. So big outperformance. So in this video, we're going to talk about the business, the moat, the numbers, and of course, at what price it can be interesting to invest in LandBridge. The history of the company is kind of short, okay? You have IPO in 2024. In November 2024, they completed the acquisition of approximately 5,800 surface acres in Lea County, New Mexico, and subsequently increased its 2025 guidance. In December, the company closed the acquisition of 46,000 surface acres in the Delaware Basin, further expanding its land holdings. And in March 2025, you will have the next financial reporting, so in a month approximately. How they earn money? So they have surface use royalty and revenue, okay, kind of same than TPL, earn revenue from surface use royalties and other surface related activities. So it's when they lend the land and to a petrol company, data center, and so on. And also the minerals, the gas and oil that they will use on this land, that they will extract, they will have royalties on it. Also, they have data center development, revenue from a long-term ground lease for data center development on approximately 2,000 acres on its land. Resource sales and royalty, revenue is generated from the sale of resource and associated royalties. Solar facility, revenue from a 250 megawatt solar facility. Oil and gas royalties, receive royalties from oil and gas production. The clients, generally oil and natural gas producer, okay, collaborate with energy companies, engage in exploration and production activity, providing them essential surface access and infrastructure support. Data center operators, okay, they provide land and resource to data center operator, facilitating the establishment of data centers on their properties. It's kind of the same, but for two different things. One is for gas and oil, the other one is for data centers. They produce also water management company. The company collaborates with a firm specializing in the management of produced water from oil and gas operations, offering land for infrastructure development. And also renewable energy developers. The company supports projects such as solar power generation, offering land and resources necessary for the development of renewable energy facilities. So sales, everything in United States, mostly Texas, okay, and New Mexico as well a bit now. The sales by product is 55% for surface use royalties and revenues, resource sales and royalties 29%, and oil and gas royalties 16%. The market, okay, they have, I'm not saying one competitor, but it's the main one, it's Texas Pacific Land. Impressive revenue per acre compared to LandBridge, okay. Texas Pacific Land have around $800,000 per acre, okay, compared to $330 per acre for LandBridge. So TPL now is more focused on oil and gas, while LandBridge is also pivoting a bit to the data center things and so on. That's for me the main thing, the revenue per acre. If LandBridge will be able to double it in the next years, then we may have something interesting. But if it stays that low, I'm not sure it can be good. We will discover more a bit after, but this is something you need to note for yourself when you will do your due diligence, your research about the company. Check this revenue per acre, because compared to TPL, TPL is really good for this. LandBridge, a bit less, okay. I have it somewhere with my notes. if I find it, but it's something like LandBridge, they own approximately 275,000 acres, okay? And TPL, they own something like 875 acres. So they are way bigger, but they also monetize better the surface that they have. The team, you have Jason Long, which is CEO, Roger Dasson, CFO, okay? Owners, interesting position is from Horizon Kinetics, okay? It's the main shareholder, everything is from them. So you may want to research a bit more about Horizon Kinetics as well, because it's somewhere important. They own 31% of it with their ETF and so on. The product, are they essential? Yes. Oil and gas group, data centers, they need water to cool down systems. They need lands far away from people and energy to do business. LandBridge has it because energy is cheaper in Texas. You have a lot of land available also in Texas and in New Mexico. So yes, LandBridge. The product is essential for those companies. Are the sales predictable? Is there any regularity? Yes, they earn royalties all over the year, no matter how the land is used. Is it wide market with tons of clients? Yes and no. Only for oil and gas group and now data centers, but data center use less space. So a wide need, but a wide market, I don't know if we can call it a wide market. Like you will not have 1,000 different clients, you have few clients. Is it difficult for client to change to competitor? Yes, because they will need to change all the infrastructure. When you have the land, you have all the infrastructure on it. So it means that you may need to find another land with the infrastructure or to build then the infrastructure, which takes time, especially for data center. When you build a data center, you cannot destroy it and just rebuild it somewhere else. It takes really a lot of time. Yeah, it's difficult to change to competitor. As a product resilient to change and innovation? Yes, because it's land, it never changes, it's always like this. We may have some scariness or some problem with either actually steal some petrol and so on in Permian Basin, but the truth is, yes, you have even more of oil, gas and so on than you potentially have in Russia and other countries. So it's a very, very good area. The position, are they market leader? No, and TPL has better revenue per acre for now. Is the market open or closed? Can competitor enter easily? Yes and no. I would say no, because you need expertise to buy the good land, to pay the good price, you have the contact and so on. But yes, in a sense that potentially everybody which has money can enter. But it's a little yes, because you need also to have the different synergies. For example, LandBridge has this synergy with WaterBridge. You need to have all those pipeline, all those things on your land. You need to be able to provide with all of this. So it's not that easy to enter in this market. So technically, on the paper, the market is not really closed, but when you look in practice, LandBridge and TPL have way more chance to continue to grow on this market. Are they price maker? Yes, they can, because they own the land and the resources on it. Is it easy to forecast growth? I would say yes, because it's kind of stable, and it also depends on the acquisition. If they do good acquisition at good price, you can kind of easily see the growth that you will have, because it will depend on all the acquisition and the sales that they will make from it. Are they dependent on geopolitics? Yes, a bit. Oil and gas market fluctuate a lot, so production changes as well. It's cyclical, so this can give some problems, especially now with the Trump administration that wants the petrol to go down and so on. You can have a bit of oil and gas fluctuation on the market, so we'll see. For management, is it easy to manage this company? On the paper, yes. You need to be good to spot and buy lands and good negotiator. So if you don't have 100 things to manage to be good in it, you just need to be good in one thing. So yeah. Is there a good growth potential? Yes, the growth is expected to be around 40% for 2025. Is the company focusing on creating good products? They focus on welcoming data center and providing all what they need. So they need cheap energy, water to cool system, and for oil and gas, they need also to have lands where you actually can have oil and gas. And also you need to be a bit far away from where people are living to not have some pollution problem, noise problem, and so on. As important team members good? Yes, the CEO and members of the team seem very competent, and they seem that they are here because they know what they are doing. So this can be good. When it comes to the strength of this company, they have strategic location on approximately 273,000 surface acres in the Delaware Basin, a prime area for oil and gas development. So it's not all of it in Delaware Basin, you have a bit in New Mexico as well, but it's a good area. They have strategic land acquisitions. The company is actively expanding its land holdings through strategic acquisition, particularly in Delaware Basin, enhancing its growth potential. Diversified revenue stream, okay, they generate income from surface access, renewable energy projects, produced water management, and data center operation. They have also a high EBITDA margins. The company boasts industry-leading adjusted EBITDA margin of 88%, indicating strong operational efficiency. And they have good partnerships and synergies, leveraging relationship with companies like LandBridge to capitalize on synergies and drive value from its land and resources. The weakness: high dependence on energy sector. Revenue heavily reliant on oil, gas, and energy-related activities, making it vulnerable to energy market fluctuation. The potential regulatory risk: exposure to environmental regulations and land use restrictions, especially concerning energy and water management activities. They have limited operational history, okay? A newly public company, IPO 2024. It lacks of long-term track record, which may affect investor confidence. And I think that's where maybe we can have some good value, because you don't have a lot of financial data. The financial data is difficult to understand because since the IPO, they had to spend a lot on the legal fee and so on to do this. So the numbers don't look really good if you look from a normal website like Google Focus, FinChat, whatever. But if you look at the adjusted thing that the company provides, it looks way better. And not a lot of people will look to the adjusted thing. Not a lot of people will try to understand it. So that's why you may have some good opportunities here. When it comes to concentration risk, operations primarily focused on Texas and New Mexico, increasing susceptibility to regional economic or regulatory changes. And also a capital-intensive business model is require a significant capital for land acquisition and development, which can strain cash flow during downturns. When it comes to opportunities, renewable energy project, okay, initiating a 250 megawatt solar project in 2025 to further diversify its revenue streams and capitalize on the growing demand for renewable energy. Produce water management, okay, increasing demand for sustainable water management solution in oil and gas operations creates growth avenues. You have also the data center growth. Rising need for data infrastructure provides opportunity to lease and land for data center development. And technological integration, use of advanced land management technologies can improve operational efficiency and attract new clients. And also you will have further strategic acquisition, okay, potential to expand its land portfolio through acquisition, increasing its assets based and revenue potential. The threats, okay, you have volatile prices for energy. Fluctuation in oil and gas prices can directly impact land demand and rental income from energy companies. I read, I don't really know if the source was great or no, but that you need to have a petrol barrel over $70 to be profitable in Permian Basin. So if it go under, less profitability, so maybe will not be interesting for them. You can have economic slowdowns. A general economic downturn could reduce demand for industrial development and negatively affect revenue streams. Environmental and climate risk, okay, exposure to climate-related risk such as drought or extreme weather can impact land usability and value. Rising interest rates, higher interest rates could increase borrowing costs, affecting expansion plans and reducing land value growth. Intense as well competition. Competitors like Texas Pacific Land Corporation with larger land holdings may limit LandBridge market share growth. Talk about the moats before getting into numbers and value. I just realized I forgot to change the image for the moat. It's still ASML1. It's fine. The goal is we don't really care about this. So Morningstar, you don't have enough data yet, so you will not have a moat grade from Morningstar. The good thing is they have high ROIC, high ROCE potential, and the ROE, now the return on equity, is around 25%, so it's good. They have high barriers to entry, okay? You need the capital to get the land, the expertise, etc. High switching cost. Once you have a client, you get royalties for long because it's expensive to change all the area. Okay? Here's some questions I'm asking myself, and I would like you to ask yourself before considering an investment in this company. Okay? First is, how will they continue to grow? Okay? Are they able to continue to do some good acquisition? Will they find the money easily? Will they use too much debt or no? This is important to understand. Are data center actually needing a lot of land? Okay, because data center need less land than gas and oil producer. So it means that you need to have way more data center clients if you want to have something good for your revenue. So how much they will pay for data center? Like will they earn money on it? Or is it really more profitable for the oil and gas industry? Can they grow like TPL did? Okay, that's the main question. Can they achieve same revenue per acre that TPL or even better? Because for now, the revenue per acre is a bit small. So can they improve it? And will they be able to join TPL on it or even be better than them? So that's all for the question I'm asking about this company, and you should ask yourself before investing. When it comes to value, for now the price is around $65. The market cap is around 5 billion. Okay. The actual price to EBITDA is 50. The forward price to EBITDA is around 32. The expected EBITDA growth rate in 2025 is between 40 and 60%. And the expected EBITDA growth rate for the next 5 years is between 20 and 40%. Okay, so really good. The forward price to EBITDA I took with, of course, a low range of growth. I didn't take the high range of growth. If you put high range of growth, if you expect them to do better, it will be a bit more around 25 and 30. So before concluding this video, let's get into the value of the company and the numbers. So for numbers, as you can see, you really don't have a lot because nothing is ready yet. Okay, nothing is ready. We'll go a bit for 2055, the expectation. You could have potentially a revenue of 188, which is kind of good. Plus, you will have, EBITDA, 173 million. So they expect higher EBITDA than what the board is expecting here on FinChat. So it's interesting that the analyst thinks that they will beat what their guidance. So it can be good, okay? And if the EBITDA go to 173 million, it will give price to EBITDA, 5,000 divided by 173.5. It will give you a price to EBITDA around 28, 29, which is really not that bad. So we'll directly go into their statement, the last statement, because it will be easier to understand. We'll not take too much on numbers because you don't really have a lot. So the adjusted EBITDA margin is 88%, which is very, very good. And technically, you don't have a lot in terms of net income. Is quite similar to EBITDA, a bit less. So you will have 88% for EBITDA, and for net income, you will have around 70%. So it's very good, okay? A free cash flow margin of 25, 26 operating cash flow margin, but it's because they had some expenses to do this this year because of the IPO, okay? Other thing important, for the full year 2024, they expect adjusted EBITDA to be between 95 million and 100 million, okay, so, which is good. And for 2025, they put it higher than what they expected before. It's supposed to be between 140 million and 160 million. So if they achieve 100 million and here 160 million, you will have a growth between 2024 and 2025 of 60%, which is very, very, very good. Okay, when it comes to some numbers, total revenue, okay, you have some good growth, that's good. The long-term liability, okay, 242 long-term debt, and the total liability 285. So if you compare this to EBITDA, so long-term debt to the total debt to EBITDA, so 285 divided by, we'll take the low EBITDA, okay, 95. Let's say this year it will not be 95, even it will be 90. Divided by 90, you have debt to EBITDA of 3.1, okay, and it's total debt. We didn't subscribe it, the cash and cash equivalent. So you have around 3 times the debt to EBITDA is around 3, which is good, When it's under 4, it's fine. I prefer when it's way under 3, like around 2. But for a business like this, when you need debt to acquire land, when you will have equity to acquire land and so on, it's good, okay? Also, the equity, the return on equity, the total shareholders and member equity is 400 million. So same, 400 million divided by 90. 90 divided by 400 million. It gives you a return on equity of 22% with the EBITDA. Okay, when you use it with EBITDA, it's 22%. Let's say now, if the EBITDA is 90 million, let's say the net income will be 70 million. Okay, so you have 70 divided by 404. It's 17% return on equity, which is good. It's far away yet from Texas Pacific Land, but it's normal because they are beginning. We'll see in the future how it will be, but it's already very promising, okay? And here, the adjusted EBITDA, you can see you have some nice growth, 25 million per quarter, so it will be around 100 million at the end of the year for a full year. So pretty good. When it's come to valuation, okay, now we'll take an EBITDA. They expect 95 million for 2024, okay, we'll put 90 million, okay. The price to EBITDA here, we expect a price to EBITDA in the next 5 years to be around 20, okay. A growth rate of 20% per year for the next 5 years. For the share outstanding, we can put something around 10% of growth each year. Okay, it may be even a bit more. We'll put 15%. Why 15%? Because if you look at Texas Pacific Land around the last 10 years, you have a growth of 11%. Okay, cumulated annual growth rate for the last 10 years, 11%. And then when they do the acquisition and they count down, they monetize it and so on, it reduces a little, but to do big acquisition they use. So we'll take some margin of safety. We'll put 15%. Now the price of the stock is around $64. Maybe it will be 65 when you look, 60, whatever. If you want to do 13% per year with this 20% rate and 15% growth rate for the share outstanding, you need to buy it under $70. If you buy it under $70, you have good chance to do 13% per year. Here, if you don't put 20 but more 25 because now it's around 30, okay, you need to buy under $90 per share to do 13% per year. So the value is pretty good. Like the value is pretty good, especially if they do better. If let's say they do 100 million for 2024, you need to buy $100 to do 13% per year. So I feel like it's really good. We take some good margin of safety here. Okay, I hope it will not be higher than 15% per year of dilution for shareholders for the next 5 years. We will see how it goes, but I think we can have some, there is some good values here. The main data, the main things to pay attention is how will they dilute the shareholders, and also will we have a growth rate of 20%. I think the 20% for the next 5 years is really achievable, even maybe more. But this, the 15%, depend how they acquire, because they already have debt to EBITDA around 3, so they can go to 4. It depends how they will manage to make money from the land that they have. So it's the value can be here. We can have some very serious value for this company, and the price under $70 for me it's good. I personally would wait maybe under $60 to enter on a position, okay? But $70 is still under $70, like now it's 64, 65. It's not stupid, okay? You're not paying, extremely overpaying it or anything. You have some good value, okay? So to conclude, you have a great combination, a great synergy with WaterBridge, between LandBridge and WaterBridge, so this is good. It's an easy business, very profitable with little cost, okay? They have almost no cost. You have the land, you buy the land, and then you have royalties on it, so good. The management seems very competent to achieve growth, and good value if you believe that they can grow by 20% per year. You have some good value here for this stock. So that's all for this video. Let me know in the comment section, what do you think about LandBridge? Is this a stock that you have in your portfolio? Are you interested in it? Or For you, maybe it's a bit too difficult to understand fully the business. What are your thoughts on it? What do you think it's a good value for it? And if you enter, at what price would you enter?